What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis, CPA, business owner, and real estate investor. Today, we're going to flip things a little bit from what we covered in our last episode. So last time we talked about seller financing from the seller's side of the deal, how to defer taxes, structure the deal, avoid common traps. But what about the buyer? What does seller financing mean for you as the investor on the buy side? Are there tax benefits or hidden landmines to watch out for? We're going to kind of talk about all of that in this episode. And by the end, hopefully you have a solid understanding of how to evaluate structure and best use seller finance deals on the buy side as well. So let's get into it. So start, simple question, why would you as a buyer want seller financing? And there could be several reasons for this. Maybe you can't qualify for a traditional loan. Maybe your credit's not great and you're in the middle of fixing that, or you're self-employed and the banks don't like your income, or you don't have enough history as a self-employed individual. Maybe you just need to close quickly. Seller financing kind of cuts some of the red tape. There's often more flexible terms on seller financing, or maybe you just want to pick up a cash flowing property without dealing with a bank. Whatever the reason, seller financing can be a good tool to use even on the buy side. So like any deal, it's not without its own tax and legal implications. So let's kind of talk about that. In a typical seller finance deal, you're going to have to negotiate a purchase price with the seller, just like any deal. There'll be a down payment somewhere, maybe 10, 20, 30%. And then there's going to be a promissory note for the balance. That's going to tell you what the interest rate is, the payment schedule, loan terms, all of that. That's an agreement between you and the seller. And often there's the seller is going to record a deed of trust or mortgage, depending on the state. So they have some recourse if you default. So from a tax standpoint, the good news is it's treated just as buying any other property. That means you'll get the same tax benefits. So things like mortgage interest deduction. So you can still deduct the interest you pay to a seller, just like you would if you were making a repayment to a bank. Now, the key is the seller should be reporting that interest to you on a Form 1098, or at least somehow acknowledge the payments with a proper amortization schedule. To protect yourself, consider using a loan servicing company. They'll document the payments and make sure the 1098's issued. But if you're trying to keep things easier and not deal with other third parties, make sure you agree to a repayment schedule and at least have an amortization schedule in place up front. And you also still get the same depreciation deduction. So once you own the property, whether it's financed by the seller or a bank, or if you pay cash, you depreciate the building portion of the property over 27 and a half years residential or 39 years commercial, and you're depreciating that entire building cost. Doesn't matter if you paid out of pocket or financed some of it. That's really one of the powerful things about using leverage. So seller financing doesn't change any of that. Just make sure you get a proper allocation of land versus building in the purchase contract. If not, you can use property tax records to come up with that. But depreciation is a big part of your annual tax shelter, so you want to get this part right early on and up front. You still can deduct the other things like property taxes, insurance, repairs, maintenance, property management, just like any other rental. The financing source does not affect your operating expenses. So far, so good. Now, seller financing can get a little tricky if you don't structure things right. So there's some key issues that I see often in deals that use seller financing. So sometimes there's no interest rate. So some sellers don't want to charge interest. They want to keep things simple. The problem is if there's no stated rate of interest, the IRS can impute interest, meaning they'll assume you're paying interest even if the note says you're not. So this affects both your deduction and the seller's income. So to avoid issues, always make sure there's a fair interest rate. The IRS publishes something called applicable federal rates, AFRs, every month. You can use those as a baseline. That's the minimum rate you should be charging. So what happens is if the IRS comes in and imputes interest on a deal that or on a note that has none stated, well, that means a portion of these payments that you thought were all going to principal are now actually a portion that's being allocated to interest. So you have a smaller principal portion going, which decreases the purchase price and decreases your depreciation deduction. So be careful, make sure there's an interest rate in place. And a second item I see that often seller financing comes with a balloon note. So a lot of seller finance notes might have a 5, 7, or 10-year balloon. So you're going to amortize it maybe over 30 years for the first 5, 7, 10 years, and then make a balloon payment at the end. So you're making small payments for a few years, then you owe a big chunk at the end. So you're going to either need to plan to refinance before the balloon hits or make sure you have some cash on hand to cover that. And understand interest rate implications over time. So most of your early payments are going to be interest rate heavy. And as you get farther along, more is going towards principal. So you want to make sure you understand where your loan's sitting and if you have the ability to refinance or have some sort of plan in place to cover a balloon payment if it does come with one. Another common issue is there's no escrow account. So with banks, usually your property taxes and insurance are escrowed. So they're baked into your monthly payment. Seller financing, that's going to be on you. So make sure you're monitoring your cash flow and you have enough reserves set aside to cover that when those bills are due. Last, reporting and documentation, another area. So, you need to make sure you're tracking interest every year. Ideally, you'll get a 1098 or at least there's an amortization schedule in place so you can track the interest versus principal payments. Make sure your property taxes and insurance are covered. You've got the documentation and receipts for those. Depreciation, that's going to be based on the closing statement. So you want to make sure you get that recorded correctly with the proper land and building allocations. And then to make sure you're tracking all of your typical operating expenses with some sort of bookkeeping software or a spreadsheet. We have templates we share that are kind of set up similar to a Schedule E. So making sure you're keeping all your documentation, always key. Doesn't matter if it's a regular rental deal or if you're working with seller financing, make sure you're saving all of your receipts and documentation. You may want to consider a cost seg study. If it's a high value property, you can accelerate some of that building cost. We've covered cost seg studies numerous times, so I'm not going to go into the details here. So now let's just some final practical tips for buyers. So make sure you get your note, the promissory note, reviewed by an attorney. Don't just use a template that's free online. Don't skip the title work. Just because it's not done through a bank doesn't mean those issues disappear. Make sure you've got title insurance. Think about using a servicing company for larger deals with longer term notes. That way you can make sure all that documentation is being handled. And negotiate prepayment terms. Can you pay this off early with no penalty? It's important to know if you need to refinance later. So bottom line, seller financing from the buyer side can be a great tool, especially if you need flexible terms, you want to move fast, or you just like the idea of having a bit more control over the deal without using a bank. You just need to understand, tax implications very similar. Make sure everything's documented and you have good records and backup to support the note payments, some sort of amortization schedule, and just plan for managing balloon payments if necessary. So that about does it for today. If you found value in this episode, hit that like and subscribe button and share it with another investor. Until next time, have a great day.
Are you interested in becoming a client? Click the Discovery Meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.